Welcome to this Peak Prosperity webinar produced with the help of our good friends at goldsilver.com. Here at the start of 2020, we've just said goodbye to the 20 teens, a decade defined by central bank intervention. Since the great financial crisis began in late 2008, the world's central banking cartel has increased the global money supply by a net total of roughly $14 trillion, often handing off the money printing baton to one another over the years. And despite being in recovery for the past 10 years, the majority of the world's central banks are back shoving liquidity into the system once again. So where has all this intervention gotten us? Many would say to the peak of the biggest asset price bubble ever blown in history. For example, total US market cap is currently trading at 153% of GDP, the highest ever. And there's a tremendous wealth gap that's continuing to get worse and worse. 500 people own 6 trillion of the world's wealth. The top 1% owns nearly half of all the wealth in the world. And yet at the bottom 60% of the world's adults have less than $10,000 to their name. How did we get here? And how will these extreme imbalances resolve themselves? To help clarify what the future is most likely to bring is today's powerhouse of macro and monetary experts. We have Mike Maloney, founder of goldsilver.com and creator of the excellent Hidden Secrets of Money video series. Mike is one of the foremost monetary experts on the planet. Mike, thanks so much for joining us.
It's great to be here. Thanks for having me. This is going to be a wonderful discussion. You've put a great group together.
Thanks. It is a great group. And you're joining us from Puerto Rico, correct?
Yes, I'm in San Juan, Puerto Rico.
All right.
Where they know how to make everything confusing and they add a whole bunch of laws, but they do have some tax breaks that Americans can't get anywhere else.
All right. Well, hopefully maybe we can learn a little bit more about those during this this webinar. Next, we have Grant Williams, author of The Things That Make You Go, investment newsletter, and co-founder of the acclaimed Real Vision interview series. Grant, thanks so much for joining us as well.
Adam, thanks. Always a pleasure. Always a good chance to have a chat with you guys.
Thanks. And you're always popping off around the world, but where are you today?
I'm in a very wet and very windy South Carolina today. So it's it's not cold, but it's a good day to chat on the computer and not play golf.
Okay, great. Well, at least you're in our hemisphere this time. Thanks so much for joining us. Now from Hawaii, we have Charles Hugh Smith, proprietor of of2minds.com, where he provides insights into the economic and social trends shaping our world. Good morning, Charles.
Good morning. And I'm currently in the big island of Hawaii.
All right. Well, thank you for getting up with the sun and joining us today. All right. And last but not least, we have my fellow co-founder from peakprosperity.com, Chris Martenson, who also is creator of the Crash Course video series, who uses the lens of the 3 E's, the economy, energy, and the environment to forecast what lies ahead in the future. Hey, Chris.
Hey, hi, everybody. It's really good to be here with everybody. I'm just so much looking forward to this panel and what everybody has to say. It's going to be really good.
Great. And you're piping in from New England somewhere, right?
Yeah, we're having another dreary, miserable day up here. It's wet and rainy and also icy. So welcome to almost January.
All right. Well, gentlemen, the theme of today's webinar is WTF, which is an acronym that stands for several things. But for us, we're going to say it stands for What the Fed. I think, gentlemen, by 2018, everyone in this panel was busy ringing a bell warning of a massive asset price bubble. Now, that was a year ago. Fast forward across 2019, and you know what? All we saw was that asset prices further shot the moon. The S&P up, I think, roughly 30%, NASDAQ up over 35%. Ever since not QE was announced by the Fed in October 8th of this year, that rate of increase has only gotten even more manic. What the F is going on here? So I'm going to direct our first question to Chris. Why don't you kick us off here? How did we get here? What is driving this crazy asset price bubble that we're living through right now?
Oh, that's easy. It's just the central banks at this point in time. They've proven themselves to be serial bubble blowers. And I think to really answer that question accurately, we got to do a big rewind and go back a bit to Greenspan. Remember that guy, the chief mumbler in chief? And what he did was he decided that it was a wise decision, maybe for the Federal Reserve, to intervene and see if it could do something really elegant and creative, which would have been fun if they could have pulled it off, which was eliminate the business cycle. Well, you can't just eliminate the business cycle. So what did they do? They decided to replace it with something called the credit cycle. And like all good rationalizations, I'm not saying it's rational, I mean a rationalization. They had the Y2K thing, if you remember way back when. They had long-term capital management. But even before that, they had a little hiccup in the corporate bond market in 94. It led them to remove constraints on the fractional reserve component of bank lending, little arcanes called the sweeps rule. But what happened was it really allowed banks to completely disappear from their books anything that they would have to reserve against. Well, guess what? If you have to reserve pretty much zero, you can lend infinitely. So we got the crazy internet bubble, and then that burst. So what did the central banks do? Did they say, wow, that was dumb, maybe we should not have done that? Nope, they doubled down. We got to Bernanke's 1% blowout rates. We got the housing bubble. That blew up. That would have been a great time to say, well, I think we got that wrong again, only worse. And what happened? Well, we went to 0% blowout rates and negative in other countries, and all the world central banks really joined in this latest frenzy. And here we are. This is serial bubble blowing. And really, if you want to know how we got here, it's nothing more to me than a series of increasing interventionist policy errors that are now compounding. And it's given us pretty much what you described, this everything bubble. You know, this last year, it wasn't just the indexes that went up. Everything went up. You know, a rising tide lifts all boats and floats all plastic trash, right? High yield bonds went up. All the indices went up. A lot of commodities went up. All sorts of things. Like pretty much, I can't find a negative asset class out there for 2019. The narrative is everything's getting better, but we really have to understand why that flood of liquidity came in, and that it was the central banks that are responsible for that.
Great. Now, Grant, you've written a fair amount about the central banks and what they've been up to and the implications that Chris was just summarizing there. What would you add to what Chris just said?
Well, Chris hits the nail squarely on the head, as he always tends to do. And you know, look, it can get a little bit boring, frankly, talking about the central banks, because you know we understand what they've done. They've been doing it for 25 odd years now, in bigger and bigger fashion every time they've been called up to bat. But we have to remember that we spend our entire lives looking at this stuff and trying to understand it and trying to get a picture of what's happening, why it's happening, and the effects it's having, the unintended consequences. And one of the things that I think the holiday season does for guys who are immersed in financial markets is you do tend to take a bit of time off, and you do tend to spend it with people who aren't in financial markets, and you talk to people that live normal lives and don't really pay any kind of passing interest to the world of finance. And what I found this holiday period is every conversation I've had with someone that hasn't been in finance, when you get around to this topic and you start explaining to people what's going on, and believe me, I'm not one of those bores that wants to bring the subject up. These are organic conversations, and people, you know, have a curiosity because they feel like something's not right. And the extraordinary thing to me is that people who don't immerse themselves in this don't understand it. They don't understand the direct linkage between central bank policy and social unrest. They don't understand the direct linkage between Alan Greenspan and the rise of Donald Trump in America, and Brexit, and Viktor Orban in Hungary, and all these right-wing politicians. But when you sit down and you help people connect the dots, and you see the kind of veil lifted from their eyes, it's extraordinary. You know, people understand that the cost of living is going up. They understand that they don't feel better off, but they're constantly being bombarded with headlines or tweets saying the economy is the greatest it's ever been. And I think we in the financial community need to remember that we are immersed in this and we do understand it. And so to us, it seems very straightforward. But I think to the man in the street who doesn't understand the role that central banks play, doesn't understand the importance of interest rates, it's a very complicated set of dots to join.
You know, I'm really glad you highlighted that, because it's always been perplexing to me that we as a society, Americans have an opinion on virtually everything, except when it comes to the topic of economics. For some reason, whether we've been conditioned, taught, or we're just intellectually lazy, I don't know what the answer is, but we've abdicated our opinions of the economy and how it should be run to a very small number of people that are, either in our ivory tower universities or in Washington, D.C., running these institutions. For some reason, I guess when math gets involved, we just say, oh, that's complicated. I've got to leave that to the experts. But what's interesting is you really are putting your finger on something that a lot of us who watch this stuff all the time, as you said, really believe, where you look at a lot of the social ills that are currently going on right now, and we can pretty directly put our finger on Fed policy as a root cause of a lot of them. And right now, people have yet to make that leap or connect that dot in their minds. But it's interesting because a question I'm going to ask with the panelists in just a moment is how far away are we from that light bulb perhaps going off? And Mike, I want to direct this to you because you have seen, and you've explained in your Hidden Secrets of Money video series extremely well, that history has seen these types of imbalances over time, where the money supply has been perverted by those in the ruling class for their benefit at the expense of the masses, where wealth inequality has gotten so large that the populace has finally rised up in revolt because it really had no other choice. Is this true? Is this something we've seen again and again in history and likely to see again in the future? And if so, how near of a future?
Absolutely, it's true. But one of the things is there's a little twist every time. There's something that's a little bit different. And so the outcome is going to be slightly different. This is the greatest manipulation in history. There's never been anything to this scale before. But when you look back at history and you see, well, let me see, they tried that 100 times before, and the outcome was always this. You just know that that's what's going to happen again. And I know that right now, Chris is getting ready for an event. I'm shopping for a ranch right now. I'm going to be installing a bunch of solar and have my own water and power. And I've got my electric cars, so I won't need gasoline and such. But the more that I study everything that they've been doing, the more fearful I become for the common man, the person that doesn't really, I was out to dinner with somebody last night, and I started talking about this stuff, and most people don't even want to hear it. I mean, some people are interested in what's going on, but a lot of people just want to bury their head in the sand and not get prepared for anything that's coming. And, economics is a closed system. It's a closed loop. And when you mess with something over here, there's going to be a reaction. I call it economic energy. There's economic energy that is being stored up by all of the manipulation that the Fed does. And when it's released, it's released in the opposite direction to try and rebalance things. Right now we have this warped economy where the Federal Reserve and the other central banks around the world have stolen wealth from the poor and the middle class by inflating the currency supply, diluting it, causing the prices to go up. What we have isn't really all of the assets rising, it's the dollar falling and all of the other currencies falling. They're purchasing less and less stocks, less and less real estate. So it's the currency going down more than it is the markets going up. However, they're going up out of balance with the rest of the economy. It isn't GDP rising across the entire economy. It's the markets and real estate going up, and it's being stolen from the rest of the economy. And when the free market tries to correct this, it comes in the form of a giant stock market crash. But this time, we came very close a couple of times to the entire world monetary system freezing up, all of the interbank lending freezing up. That means the credit cards stop working. That means the gas stops coming out of the pump, and eventually there's no more cell service or things like that. And the more I'm writing a couple of books right now, and I've got to do an awful lot of research and spend a lot of time on the Federal Reserve's website generating charts and trying to figure out what they're doing and reading reports and so on. And the more I learn, the scarier it becomes. It's just absolutely amazing what they've gotten away with. And this is basically criminal activity. They are stealing from the poor and the middle class by diluting the currency supply and causing prices to go up. And they're bestowing this stolen wealth on the wealthiest people on the planet. Since the crisis of 2008, Amazon stock is up 34 times, Microsoft stock is up 10 times, and anybody that derives the vast majority of their net worth from their stock portfolio, like Bill Gates and Jeff Bezos, they became centibillionaires. They're both worth more than $100 billion. And it isn't their fault, it's the Federal Reserve's fault. But wealth was directly stolen from the poor and the middle class and given to them by driving up the stock prices. And it's just to try and fool everybody into this believing that we're in this healthy recovery. And it's not a healthy recovery. There were no new goods and services created to match the $3 trillion that they whipped up out of nowhere. This wasn't true wealth. True wealth is the goods and services and us doing business with each other. When they just create currency, and the correlation between QE and the rise of base currency and the market cap, the stock market capitalization, the Wilshire 5000 total market cap index, the correlation between the two is 0.985. So they're only 1.5% uncorrelated, basically. It's an exact match. You create a certain percentage of more currency and the stock market goes up by exactly that percentage. And it did for the entire period of QE. And so that this, if this is just a bubble that they've blown with a bunch of hot air, that when this bursts this time, it's dangerous. This is something that people really need to protect themselves against.
All right, great. I'm interested a little bit later on exploring potentially how bad each of you think it could get, and then ways in which people can take action. But it sounds like, Mike, from what you're saying, you think it can get pretty bad, bad enough that you're looking for, a resilient, off-grid, self-sufficient
Yes.
Retreat to perhaps go to.
Well,
Charles,
there's tail risks, and even if it's just a 2% or a 5% chance that the monetary system will freeze up, it means that ships are going to stop coming to Puerto Rico to bring us all the petroleum that they generate the power with and pump the water with. And so there's a tail risk, and I hope it doesn't happen, but if it does, I want to be as prepared as possible. There's also a wealth transfer that occurs with these things, and you can actually come out better financially. It's just that the world is going to be quite a bit different after this coming event.
great. And I also want to talk about that too a little bit later on, which is, in addition to getting your defenses in place, what are some ways to position yourself, as you just mentioned, Mike, that there may be some, once in a generation opportunities to position yourself to prosper here from the correction. But let's hold that just for a second, because I want to give Charles a chance to dive in here on this point. Charles, I know you and I have talked a bit in the past about a lot of what Mike was talking about. He talked about that near 100% correlation between central bank money printing and financial assets going up, which then exacerbates the wealth inequality, because it's really only the top percentiles that own the vast majority of those financial assets. Two questions for you. Sort of where do you see this headed at the current trajectory? And one of the questions that I think I've tossed out to you, and I think you in the past too, Chris, is what's it going to take for the pitchforks to come out? Like, how much more does the common man need to be abused before he sort of wakes up to this and says, I'm not going to take anymore?
Oh, those are great questions, Adam. And I would start with making a quick comment on Grant's comment, which is, it's interesting that everybody wants more money, but when you start talking about where money comes from and how it's distributed, everybody's eyes glaze over. It's remarkable. And then I want to speak to Mike's point about the connection between central bank policy and central banks and the real economy. And that transmission is partly what's broken. And that's what we're talking about today, is the central bank policy is not helping the real economy and everybody that's engaged in real economy activity. But I want to go back for context. Let's look at what has been the key driver of the last 20 plus years of so-called economic growth. And we can, of course, look at central bank policy, but we can also look at globalization and financialization and technology, right? Now, everybody's a fan of technology and everybody says, oh, the internet, that's what's driven global growth. That's certainly been part of the impulse that's improved productivity, right? Is digital technologies. But we have to go back and look at what globalization plays here. And that globalization in general is, we can kind of talk about it in a variety of ways, but it's basically arbitraging labor costs and cost of capital and cost of environmental protection, right? And so if you're a global corporation, you want to seek out a place with cheap labor, no environmental controls, hopefully a corrupt government that you can buy off to get rid of any spots of bother, and a place where your capital is going to earn a high return, because either you can get into a monopoly or create a cartel, or you can exploit tax laws. So this is not the globalization that the idealized version that we were taught in history, where the Chinese sold silk and then the Europeans, gave them gold and silver, and this kind of what you might call win-win globalization. Well, that's not what we've been experiencing for the last 20 plus years. And of course we know that China was a key element in this, right? That global corporations move production to cheaper locales in Asia, and then they basically skimmed all the profits generated from that. And as we all know from the real world, the quality of products has generally declined, often precipitously, and the price drops are insignificant in the total cost of living, right? Your college tuition goes up $10,000 every 2 years, but we're saving $100 on a TV, yay. Your healthcare insurance quadrupled to $4,000 a month, but hey, you save $50 on jeans, okay. So globalization has been one of these key drivers that Mike was talking about in terms of stripping the wealth away from the bottom, say 95%. The other one is financialization. And this is one of those slow glacial things that we forget what the world was like only a few decades ago before rampant financialization. Back when people paid with cash, debt was a relatively rare thing other than your mortgage. Auto loans were 2 or 3 years. And now we live in a world that's fully financialized. And in my terminology, it's reached, both globalization and financialization have reached the top of the S curve. All the easy fruit has been picked from those two dynamics. And so now we have a world where debt is required in order for people to consume anything. Everything is leveraged to the hilt. Everything that used to be in private ownership is now monetized, and the benefits flow to corporations. For example, Uber. Now Uber is basically monetizing private vehicles and skimming off most of the money, and then transferring the risk of operating that business to the driver, who may or may not make money, as an example. And then there's, of course, securitization. What used to be a low-risk mortgage that was held by a local bank has now been securitized with a bunch of garbage mortgages and sold to a pension fund in Norway. And so that's another aspect where financialization and globalization work together. In other words, if you want to securitize garbage, then you want a global market so you can find suckers and chumps around the world, right? And the Federal Reserve is, to bring it back to the topic of the day, the Federal Reserve is the central bank to the world. If you look at the 16 trillion that they backstopped and guaranteed in 2008 and 9, a vast amount of that was non-US banks and institutions, right? So when things get serious, not only do all central bankers lie, but they turn to the Federal Reserve. So it's a global central bank, and as you say, they coordinate. But the 800-pound gorilla in the room is the Federal Reserve. So it's playing a double role here. It has to manage the global financial system as well as the American financial system. To your point about pitchforks, I think we're clearly seeing the social disorder that's arising as people realize their standard of living has been declining for the last couple of decades, while globalization and financialization have transferred all the wealth that's been generated to the top of the pyramid. And when will people wake up to the fact that this is this disconnect between finance and the real world, that the financial sector is benefiting enormously, but the real world of the bottom 80% is not? when will they wake up to that? I don't know. I'm surprised that it's been such a challenge, but I think we can draw some sustenance from a growing awareness that putting money and creating money at the top of the pyramid and hoping some of it trickles down is not working. And I think that awareness is rising.
Yeah, and just looking at the recent presidential debates that we're having and the political mood in the country, I think the social malaise that you're describing, where people are just feeling increasingly, depleted of their standard of living. They might not know the source of it yet, but they're certainly feeling that pain and frustration. And I think that that's sort of at the root of a lot of the democratic socialism that's rising in the country right now, the progressive movement, which tends to promise, hey, we'll give you some make good programs here, whether it's we're going to pay for your college for free or healthcare for everybody or whatnot. Now, I'm not making a judgment call, good or bad, one way or the other. I can just say it's understandable to see younger generations that don't see a lot of hope in the future in the current trajectory beginning to migrate to politicians that promise them things like that. All right, so switching to the world in which we live today, which is, like it or not, the central banks are continuing to ease aggressively, actually, here at the end of 2019, beginning of 2020. So sort of a double question for both of you, and Grant, I'll direct this to you first. What do you foresee as the implications of this most recent not QE program being pursued by the Fed, the US Fed? And what is your short-term outlook for the markets and the global economy, short-term 2020, 2021?
Well, the implications are very, very simple. Something is wrong in the plumbing of the financial system. And it doesn't matter what anybody says. It doesn't matter if they try and tell you that this is just, it's either arcane or it's irrelevant. There's a chart of the Fed's repo balance, which if you take it back to 2000, you'll see the spike and the magnitude of what they've done in this last couple of months. And you take one look at that chart, there is absolutely zero chance that you can say it's not meaningful. Now, do we know exactly what it means? No. And I suspect we don't really want to know. And I'm certain that the Federal Reserve don't want us to know. But something is very, very wrong in the plumbing of the financial system. And that has necessitated them coming back in with all kinds of excuses. But the plain truth is we're in the middle of QE4 right now. How long it's going to go on for, we don't know. How much they're going to spend, we don't know. We knew what the parameters were for QEs 1, 2, Operation Twist, and QE3. They set out in advance what they were going to do, how much they were going to spend. This is completely seat of the pants stuff. And it tells you that they're concerned. It tells you that as we come into the year end, when for all kinds of, again, arcane reasons, there is an awful lot of money that needs to flow around this system as people close their books for the end of the year, and it puts pressure on funding costs. They are going to have to throw the kitchen sink at this to make sure that we get through. We're recording this on the 30th of December. We get through tomorrow without any major dislocations. What it means for markets, if you look at whatever happens when the central banks inject liquidity into markets, as Mike pointed out, these injections of money into markets have a very predictable response. They drive markets higher. What changes is the amount of money needed to be injected in order to create the outcome they need. And this one particularly doesn't seem to be designed to juice the market, which the other ones specifically were. This one seems designed to stop a major meltdown in the markets, which is a wholly different beast. If we're now into crisis prevention mode rather than reflation mode, which is what they would argue they were doing in the first 3 episodes of this, then it really is a matter of time until something breaks. We have the election coming up, obviously, in November 2020. I dare say everybody concerned would like things to maintain stable and markets to keep going up until then. It feels like it's a long way away, but these things have a habit of coming around really, really fast. So, what's the outlook for the markets? Look, I think you can expect markets to continue to want to go higher through the early part of next year, mainly because the Fed are going to keep injecting capital. There's all kinds of talk coming out of the Bank of England, out of the European Central Bank about what they have to do to make sure that markets function well. They are going to throw the kitchen sink at that, and that is likely to mean equity markets go higher. Does it mean the economy's doing well? No. Does it mean it's a rally that you can buy and then forget and just hold on to these things? Absolutely not. Anybody who's invested in equity markets, particularly right now, but also bond markets, needs to be incredibly vigilant about the stocks and the bonds that they own, and needs to be watching markets like a hawk, which in an age where everything is moving towards passive is kind of ironic. You know, people have been comforted by this consistent upward move in markets, and they've been more and more happy to try and save fees and put money in the hands of passive allocations just at the point where they really need to be paying the maximum amount of attention. So, you know, I think the path of least resistance is higher, but I think the very fact that QE4 is a crisis prevention rather than market reflation is a huge red flag that people need to be aware of and monitor accordingly.
All right. So big red flag. Chris, I'm going to direct it to you now because you've written a couple of pieces in the past couple of weeks, similar to what Grant said, which is what we're seeing with the Fed's reaction to what's been going on in the repo market really smells like a desperate response to something broken in the fundamental plumbing of the banking system. If that's true, two things. One, Grant had said that we can expect the Fed to continue to try to solve the problem with money, or at least keep the problem at bay. But one, how much does this smell like a 2008 to you, where it eventually was a breakdown of critical functional parts in the system that then created the great financial crisis. It wasn't just overvaluations; it was part of the system actually seizing up with credit. And then secondly, Grant, if I interpreted what you said correctly, which is we should be prepared for asset prices to continue to go higher from here as the Fed continues to intervene. But it sounds like that's just going to create an ever greater distortion that at some point when a correction happens, it's only going to become more violent when it does happen because of the additional air that's being forced into the system. Are those both accurate statements, and what's your response?
I cannot decline either of those statements. Are you asking my response or Chris's response? Sorry, I thought you were asking
let's hear yours, and then we'll punt it to Chris.
Yeah, no, I think you summed up what I said succinctly and beautifully. And I think anytime you do it, I think we've all known, I think everyone on this panel has been talking about this for the longest time and trying to explain that the longer you create this fake prosperity, the worse the return to reality is going to be. And it seems to me as though the Federal Reserve with this QE4 move are getting desperate. And that tells me that they're worried. It tells me that there is a real risk of another dislocation. The parallels with 2007 are everywhere. There's a couple of distressed asset hedge funds that have gated, just like we saw in the early days of 2007, which people kind of ignored. But when you trace it back, it was really the beginning of the meltdown. There are all kinds of signs. Gold and silver are coming to life again. Central banks have bought more gold in 2019 than they have done at any point in the last 30 or 40 years. All the signs are there. If you take them individually, they're all interesting. But when you weave them together in a tapestry, a much clearer picture emerges. And it's one of an incredibly fragile stock market and an incredibly fragile economy, despite what the percentage daily moves are doing.
All right. So red lights blinking brightly. Investors take caution. Chris, what would you add to that?
Well, Grant's, of course, done just a brilliant job summarizing all of that. And I do agree that, nobody really knows what's happened in the repo markets, as it were. But for people who aren't familiar with that term, the Federal Reserve has seriously reversed course. And if you look at a chart, which I think we could weave in maybe right here, because I have one of these prepared, there's this chart that shows the central bank's balance sheet, the Fed's balance sheet, and they started doing this gentle unwinding. It ran for about a year and a half, and then all of a sudden there was this violent reversal, which you see is that hockey stick shape where it just shoots back upwards, and that's a crisis. And of course, the thing that makes me most unnerved about it is the gap between the violent shape of that reaction on their end and then the words that they're using to explain that this was just some sort of technical thing they had to do to keep the plumbing working. No, this is a very unusual event. And we have to remember that in 2019, we saw collectively the world central banks cut rates or otherwise provide easing more than 90 times, it equals the height of the great financial crisis, right? So you asked, is this like 2008? It kind of is, but I think I see more flavors with 2000 and also with 2016. 2000 because we were there, that last bubble that kind of blew through the final end and burst finally in March of 2000 was because of all the stuff the Fed did with the long-term capital management bailout, and then later with the Y2K liquidity dumps. They just threw money into the markets. It had to go somewhere. As Mike Maloney pointed out, the more money you throw into the markets, the more they go up with a very high correlation. Might as well be a correlation of 1. So they did that, but it still burst on them at any rate. So I think that we were actually in the process of bursting again in 2016. All the indexes put up these beautiful head and shoulders patterns. We saw global trade really beginning to start to fall off the rails. You and I were writing about it. I think everybody was saying, whoa, this looks like it could be it. And then one night out of nowhere, everything, just went the other direction. And my model for that is the central banks learned that you can actually, if you put enough adrenaline into the heart of the patient, you can actually even turn around what appear to be crumbling macroeconomic statistics, right? So this was things like trade and rail shipments and all that, right? Well, that's happening again. Here we are. Every day I wake up and Bloomberg has an article about how 400,000 rail cars are idled, which seems like a pretty big number to me, or trucking traffic's fallen off. But oh gosh, the FANG stocks are hitting new highs. So there's this giant disconnect again between what we're seeing financially and economically. And I think what the central banks are doing is saying, hey, we can rescue this one more time. All we have to do is put enough money in and it'll work. But it's really a double fingers crossed strategy. And the question I think you're asking is what happens if they fail? And we all know they're going to fail at that at some point. There's only so many times you can just paper over things and supply liquidity when in fact what you have is a mounting and growing insolvency problem. Liquidity can cover that for a while, but it can't correct it forever, right? And we all know the statistics. 1 in 8 companies is a zombie company, meaning they're operating cash flows cannot meet their interest payments alone. We've seen all the distress in the households. Median household, 40% of households don't even have any money in the bank. The median has maybe $400. I mean, it's just that there's not a lot of room for error at the edges of this system. And as I like to write about, when the trouble starts, it always starts from the outside in. The weakest companies, the triple C debt, the triple B debt, the weaker households, the weaker countries, those are the places that get, just walloped first. But the distortions are so massive right now in the whole system that you can buy the junkiest debt you want, and you're going to get less than 2% extra yield on that compared to U.S. Treasury debt, right? In fact, if you want to lend money to the Greek government, they're going to give you less money back. They have a lower rate of interest than if you're lending it to the U.S. government. That's a distortion that's so. What do you do with that? I don't know. It's just that's how distorted it is. But as Mike said, that creates that financial energy, that economic energy. When that rubber band snaps back, it's going to be. The real question is, can they control it? And if they can't, what happens? Right. And we already got within a couple of whispers and whiskers of financial system seize-ups. 2008 was one, and that was the most serious I know about, but it was close. And so, rather than, taking our lumps in 2008, letting city shareholders and bondholders, both reconsider their investment strategy of lending money to a company that was that poorly run and taking some lumps, everything got bailed out. And no lessons were really learned, and the imbalances are now larger. So when you ask, the real question is, to me is, do the central banks have any other option at this point besides continuing to try and just keep everything, stapled together and pump more and more in? And the answer is, I don't think they believe they have that option. I don't think they think a creative destruction, a healthy cleansing brush fire is possible at this point. I think they truly believe if that deflation gets rolling, there's so much financial energy, it's a crown fire. And, that's going to burn a lot of things to the ground. And I think that's what they're afraid of, but I'm projecting. I don't honestly know what I would do if I were in their shoes at this stage that wouldn't risk some pretty painful moments afterwards if you decided to maybe not put so much liquidity in the system for a while.
All right. So it sounds like you're saying Fed painted into a corner, but they don't really have an option but to continue to play for time. But at some point in time, the clock will run out on them, and then who the hell knows what's going to come next. So, all right, I think we've sufficiently freaked out everybody who's been watching the webinar to this point. So I'd love to try to switch into sort of solution gear. In other words, given these massive risks, given these great distortions, given that it sounds like each one of you panelists have said, we're at a historic moment of deformation in the system, and a snapping of the system, a breakage, is highly likely to happen. Okay, taking that as gospel for a moment, what things should today's concerned investors consider doing in advance of that breakage, that snapping point, to protect themselves? Let's start with the protection, but I'd also like to get into for those that want to speculate a little bit and position themselves to actually prosper from what might occur, some steps for that too. Mike, I'm going to hand you the baton, because I got to imagine for you, but I think for the other panelists as well, precious metals are going to play a key role in that strategy. What should somebody who's watching this, who's now all spun up with anxiety about what you guys have been predicting, what should they start considering here?
Well, I never give advice. I just tell people what I do. And I measure my wealth now in tons. I go with physical precious metals, and I have some cryptos. And then I've also got, and I'm going to buy more, some emergency food. I can see a scenario where that's as good as gold also. So it's, some freeze-dried, nitrogen-packed, 20-year shelf life food. I believe that what is going to happen in this next event, they had to quintuple the base currency supply last time to get us out of what they perceived as a mess. They should have let the markets continue crashing. They shouldn't have bailed anybody out. We could have started a healthy economic recovery if we went from a solid foundation. But they've got, this foundation has cracks in it, and then we just keep on blowing this thing a lot bigger. This time, they were able to cut by more than 5% the rates.
Back in 2008.
And they had to create, they had to quintuple the base currency supply. This time, it's going to take the same percentage, but we're starting with, a currency supply that's so much larger than before. They're going to be creating not just a few $1 trillion, but tens of trillions. And I believe that what you'll see then is like a two-stage crash, where it's the markets first, and then they get the markets to come back, but then there's going to be a currency crisis because of the quantity of currency they're going to create to get the markets to come back. Is going to cause a loss of faith, a loss of confidence in the currency. If they're just, whipping up all of this currency out of thin air, and which, by the way, indebts us in the future, because they do it by purchasing an asset, and those assets are usually treasury bonds, which we pay taxes for every year to pay the principal and the interest on the currency that the treasury borrowed, up to 30 years ago. We're still making payments on prosperity that we enjoyed 30 years ago. The more I think about this whole system, the more ridiculous the whole concept of it is. And the more you investigate, the more you see that it is theft and enslavement. It's fraud, it's theft, and it's enslavement. If you take away a portion of a person's wealth by diluting the currency supply and causing prices to rise, that person then has to work more to replace that stolen wealth, and it's being given to the world's wealthiest people. It's a totally insane, corrupt, immoral system. And so there will be, hopefully there is some good that comes out of this, and that would be to start over with some system that's based on something that's real. So what I'm doing is I've got precious metals that are in storage accounts at Brinks Security. I've got some in Singapore. I got my metals out of Hong Kong because of what's going on there. I had some in Hong Kong. So Singapore, Toronto, and Salt Lake City is where I'm storing, and they're highly liquid. In fact, they're more liquid than stocks. I sold some stock recently and I was surprised at how long I had to wait for Merrill Lynch to get it back into my Bank of America account. And this is basically the same company. So it's a transfer between accounts, but it still took 4 days for it to happen. So, yeah, we've got that. And then I buy some cryptos, and yeah, I don't know what's going to happen with cryptos. Nobody really does, but we do have a younger generation that they don't see as much of a difference between virtual stuff and physically real stuff. And so there's a possibility that some cryptos will do very well.
Got it.
So, yeah.
So, okay. So I hear you personally, you're doing gold, you're doing silver, you're doing cryptos, and you're doing some physical preparations in terms of, a homestead, preparing for a time where you may need to rely less on centralized services. If you could just for 1 second, talk about the recent price action in gold, because gold, has had a pretty tough winter over the past 7 years, but 2019 really began to see the first green shoots of hope again in the precious metals complex. And as we're talking here, gold's back above $1,500 an ounce. Gold in theory is supposed to be the mirror of truth held up to the central banks to reflect back debasement of the currency by rampant inflation through money printing. I think that role has been somewhat compromised by suppression of the precious metals over the past 7 years. At least people can have a large debate on that. But just in terms of the price action that you're seeing, are you beginning to become a little bit more encouraged for higher gold prices ahead?
Oh, yeah. I think it's like total insanity to think that gold will not surpass $5,000 per ounce. I think that that's just an absolute certainty, a slam dunk. And it's all based on how much currency they are creating and how much they're going to continue to create. Gold has to do an accounting of that someday. And the accounting has begun. I, however, am very grateful for the pause that we've gotten, this cyclical bear market inside of a secular bull market. We've got this enormous bull market going on. And I feel lucky that I discovered precious metals. I've still got a tube of gold eagles that I bought when the spot price was $315. And so just being able to accumulate more and have time to get ready. I just hope that they can, whatever's happening right now, the reason for all the repurchase agreements, for them firing that system back up again of these short-term loans to banks, I'm hoping that it puts this off another 6 months or a year or 2 years, because I just want as much time as possible to get ready. I'm planning on having a place where I can grow my own food and have my own power source and my own water. And so I won't need the financial system at all.
All right. And Chris, we'll talk with you in a moment about what you're in the middle of, because I know that you've made some pretty big strides lately in that type of preparation. Charles, I'm going to get to you in a second, but Grant, I do want to pass through you because you put together an extremely well-received presentation a few years back about gold called Nobody Cares. And I think when we bumped into each other in New Orleans, I think you agreed with me that we're maybe at the point where at least somebody cares about gold again. Could you just clarify your most recent thoughts on gold, and if you have anything else to add to Mike's list of other things that an investor who's concerned about these trends might want to consider looking into, given the time they have today?
Sure. I mean, again, it's another one of those questions that we all kind of get bored talking about. We've all been espousing the benefits of gold for some time now. The point I was making in Nobody Cares, which was December 2015, was just that. The people in and around the precious metals complex focus on this thing obsessively and can't understand when it doesn't go up and don't understand why it goes down when it goes down. But it's such a small world, and the holding of precious metals in the wider financial community is very, very small. Pension funds have zero allocation to precious metals. But it's such a small market that it only takes a tiny change in that mindset that people might think, you know what, maybe we want to allocate 1% to precious metals as a hedge. That will create all kinds of fireworks. If you go back to the very bottom of the equity market in March of 2009, you look at returns since then, the S&P is up just shy of 300% since then. Now, if you had gold as a hedge, if you had 5% of your money tied up in precious metals as a hedge against what at the time was a potential disaster happening, well, guess what? That hedge is up 70% since then. If you'd gone long volatility as a hedge, you've lost all your money 1,000 times over since then. So to have a hedge that will perform in market corrections that is actually up 70%, fine, it hasn't matched the returns of the S&P over that particular time frame. You could pick any ones you like where it's outperformed. So I think gold and silver have a very important role to play in a portfolio, and I think that importance is going to increase in the coming year or two. I think people need cash flow. I keep pointing to WeWork as a sign that just as we saw at the end of the 1990s, we had all these companies priced on eyeballs, if you remember the first internet boom. And it suddenly started mattering that some of these companies became profitable, and within 6 months, the whole thing fell over. We're just starting to see that now. This idea of scale and growth and profits will come later. WeWork has proven that at some point, it doesn't matter, and people want to see profits. And you're seeing the same with Uber, you're seeing the same with Lyft. And it's a change in mindset that says, hey, maybe companies ought to be profitable. That's all it's going to take this time to completely change the landscape of the stocks that have been high flyers. So people need to be alert to this, and they need to find cash flow of their own, whether it's investing in a business. People forget that this is not all just about the stock market. We all
right.
Investing means buying stocks and shares. It doesn't. Invest in a business. Invest in something that you don't have to mark to market every day, but you can build and generate real cash flow with, and then look to invest that cash flow in productive land, as Mike is doing. It doesn't have to be about stocks and shares. If you want to look at stock markets, then I've got to think that the performance difference between the US and Asia, for example, is going to narrow in the coming year. We've seen a massive outperformance in the US, driven largely by strength in the dollar. I suspect the dollar is going to weaken, and I suspect that outperformance will reverse of being short the US versus long emerging markets. I think if you want to be in the stock market, that's as sensible a trade out there as I think you'll find. But again, people need to understand that being long the market is only really something you've been able to do successfully for the last 6 or 7 years, as passive has massively gained its foothold in the market. It used to be that you had to be long good companies. And I think a time is coming back very soon where you need to be long good companies, and just being long the market is not gonna do it anymore.
I love so many things about what you just said there, Grant. And I really appreciate the fact that you underscored for folks that, hey, the stock market is not the only option when it comes to investing your wealth. We've written a lot on Peak Prosperity over the past 2 years about the importance of investing for income, which really has sort of become a lost art, right? Income companies haven't really done much, and they've certainly lagged a lot of the high growth companies out there, the FANGs and whatnot, and the other many of the non-profitable tech companies. And I agree. I think that we're going to see a cyclical return to a preference for cash flow. And so, the danger right now is that all assets are trading at inflated multiples. And so one of the things that we at Peak Prosperity hope is that when there is a market correction, hopefully it'll bring things down to more sane valuation multiples, and then buying, dividend stocks and stocks that are in profitable companies becomes, an NPV positive option again. We do have, and Chris, I'm sure we'll talk more about this, we do have a endorsed financial advisor that we connect folks with who are sort of looking for ways to invest for people who think like our panelists do. And so perhaps at the end of this webinar, we'll put up a URL so people can go chat with them. It's totally free. There's no obligation to work with them. It's just totally informational at this point. All right, Charles, I'm heading to you now. You've heard what the Mike and Grant have said in terms of what should the concerned investor think about at this point in time. Anything you want to add to that will be great. I know that you have also taken a look at what people can do with their own knowledge capital. In terms of learning, developing mastery in areas where they can command value from the marketplace. And in today's highly mobile marketplace, I know you've talked about sort of I'm trying to remember the exact term you've called. I think it's mobile creatives. But anything you want to talk about in terms of how people can prepare, not just in terms of investing their assets, perhaps, but also themselves and their own professional skill set for what's coming. What would be some of the things that you would recommend to people watching here?
Well, that's a great topic, Adam. And I think one context I would refer back to that Mike and Grant discussed is we're talking about a market that is, when we talk about the financial market, it's extremely centralized, right? I mean, there's a handful of folks in various rooms that control the financial market. So centralized markets are really fragile. And so, but decentralized markets like a local economy, that's much more resilient. And that's where there's opportunities for individuals or households to actually engage in adding value to their a local market, right? So markets work when they're localized, decentralized. They break down and become fragile when they're highly centralized, right? And so in terms of local markets and making use of your own skill sets, I think you're going to have to pick the location very carefully. And, you know, of course, we've all discussed this in various venues, but you want to pick a locale that has a decentralized economy. If you're going to go to the classic highly centralized city that's dependent on a couple of industries, when those industries go south, the whole economy destabilizes, right? So you want to go to a place with an actual localized economy. And part of a localized economy is a social structure, a social system that goes back, in many cases, hundreds of years. And I'm thinking of villages in Japan, many of which are depopulating, right, along with the Japanese population as young people move to cities. But French and European villages also depopulating as people leave. But there's a social structure there and a farming base of knowledge that people are actually still growing food. And so, it's not just about picking your financial options. It's about picking a place that can actually survive a freeze up of the financial system. And the more informal the economy, the more likely it is it's going to survive. In other words, if you're in an economy that people deal with cash, and there's let's just call it an informal economy called a black market, perhaps, where people aren't reliant on something being shipped in, And in terms of energy, if you can find a locale where more than half of its electrical energy is already being provided by renewable resources, and that's being pushed up to 100%, that's a much more resilient place to live than a place that's totally dependent on energy piped in from hundreds or thousands of miles or kilometers. So in other words, it's not just what you know and your wealth, it's like, where is it situated on the planet? And to speak to your question about mobile creatives, the digital economy is certainly real, right? In terms of like doing work online. And a lot of people feel the internet itself is fragile because it uses a lot of energy, and it does, but not nowhere near as much as transportation or heating and cooling buildings and so on. So I think we're going to have a digital economy even if the financial system destabilizes. And so embed yourself in a localized economy where you can add value, and that's what I'm trying to do.
Okay. All right. So Chris, now you're in you're elbow deep in moving to a new location that has it's very rich in the types of sort of self-sufficiency elements that Mike was mentioning that he's sort of currently looking for in the properties that he's looking at. If you can tell folks a little bit about that, but you and I, we've co-written the book Prosper, right, which really delves into this sort of solution set of, yes, there's a lot of stuff you can do with your money, and we'll tell you about that. But then there's a whole bunch of other things we can tell you to do with the rest of your life so that you're working on building true wealth. And what's great about that is even if we're totally wrong, even if the Fed wins here, right, and the next 30 years look just like the past 30 years, these are investments that you're not going to regret, right? You're not going to regret being a good steward of your financial wealth. You're not going to regret getting into better health. You're not going to regret becoming more valued by your neighbors in your local community, right? But if we are right, and this deformation does have a big breaking moment, these are investments that are going to have a dramatically outsized set of benefits to offer. So if you could just sort of talk holistically about that in the context of what you're doing right now in your personal life, and maybe give folks, before you jump into that, just a little bit of background in the financial advisor that I mentioned, because that's one of the things that we hear loudly after we do one of these webinars is people say, wow, guys, I get everything you just told me about what might happen in the markets, but I can't talk to my broker about this stuff. He just keeps telling me, just be along the market, stocks for the long haul, don't worry, it's all going to be great. So maybe tell people just a little bit about what New Harbor Financial, our endorsed financial advisor, might be able to do for them.
Well, sure. And let me just point out, so this is the book right here, Prosper. It's got
shameless plug.
I can talk about it, but it's all in the book. We've gotten great feedback on it. And it organizes itself around the solution set. So all the problem definition, that's the crash course, all the stuff we've been talking about, the things that everybody here who's on this panel writes about, mostly with the spirit of trying to educate people, because that's the most important part. People need to have that context to know what's happening. And so in this book, we talk about 8 different forms of capital that not only can you, but you probably should be attending to. Financial capital's right at the front. It's the first one that we talk about. And the guys at New Harbor Financial, they're locked, good brainwave lock with us on all of these issues. They've watched the crash course. They've read everybody who's on here and many others beside. And so they're very conversant in what the actual risks are, and understand that financial capital is really important. But these are the kinds of financial advisors that will look at your portfolio and say, I think you need to invest in some solar on your homestead. I think that you ought to be thinking about having some gold and silver out of the system, giving you the kinds of real advice that I think all financial advisors ought to be in the business of offering, which is saying you have a whole life and you can invest across all of it. An investment doesn't just mean being in stocks or bonds. It can mean being invested in insulation, so you spend less cash on oil going forward to heat your house, if that's what you heat with, and things like that. So they take a really holistic look, and then they manage risk really carefully, because we don't, as best you can, right? We don't even know, all we know is that we're all subject to bail-in provisions now, meaning after the City Act was passed, on that provision, it's, we all run the risk of being bailed into and becoming an unwitting shareholder at unfavorable terms of any bank we happen to have money with. So something like that. So these are guys who can actually understand that risk and talk to you about it like they're not, you're not, a dog listening to white noise. They just they'll actually give you a real read on the situation. And my own personal response to all of this, because there's other parts we haven't talked about, and when I'm scanning everything in the world and I'm looking at the near apocalyptic conditions that are happening in Australia right now, with their fires, they've taken an entire province and said to people, you're on your own. We think you should just leave. They can't possibly manage the fires. It's that bad, because the droughts and the heat are that bad. And we're seeing more and more events like this in the ecological side of things. And then, my larger read on this as well is that we are not going to be able to grow exponentially forever. And that's going to create a lot of dislocations in a financial system that always has to grow. It's going to create a lot of dislocations in our political systems and things like that. So my response, because I can't control any of that, is my fiance and I are closing in a couple of weeks on a 182-acre property with some nice prime agricultural soils, lots of water. It's bounded by rivers on both sides. And we'll actually have lots of river frontage and good solar orientation, all of these things that we're going to do to build up our living capital in terms of the soil, the water, our own health, that we're going to material capital, getting in solar, hot water, photovoltaics, things like that, battery backups, what we're going to be doing in terms of also building community around that particular property. And so in my work, I've been doing a lot of talking with people about how they're reading these signals. And guess what? It's impossible to get yourself prepared for what's coming because we can't possibly know all those variables. But you can figure out how you're going to be in relationship with that data for yourself and with other people. And that's the part that I found there's a lot of hunger for. And so we've got a bunch of people who are really organizing as best we can around how do we create community out of this as well and have real social capital that can be probably the most important determinant of both current happiness and future success, I think. So it's amazing how much energy there is around this. My own personal read on it is that, yes, we're thinking rational creatures to some extent, but we have that many nerves down in our gut, and we also intuit things. People are intuiting that fourth turning vibe that we've sort of been hinting at, right? The yellow vest protests. If you haven't been tracking it, no shame if you haven't, it hasn't been on the news, but Chile is absolutely caught on fire, literally, because of protests down there. Of course, you heard about Hong Kong, but it's that fourth turning aspect refers to that time when people become restive and unhappy with circumstances, and they're living through that moment of crisis. And so my personal response to that moment of crisis is to be, like Mike, as prepared as I can be. I'm just calmer when I know exactly where my food is, where my water is, where my electricity is coming from, and that I have some nominal control over those things. And that's been my response to this, and has been for a while. But I'm dialing it up because we're moving to a big old piece of land, and I can't wait to show people the pictures of that. And as a real quick aside, we're in the process now of finding a young couple that's going to be managing the farm, because I'm not a farmer. But I'd love to have that young couple with strong backs and bigger dreams who are going to, like that movie, The Biggest Little Farm, like regeneratively using modern agricultural practices to build the soil and work with and around nature rather than against, and do those things because it's real exciting. And by the way, the output of that, as you mentioned, Adam, the worst that can happen is we're going to live around a really beautiful environment with just luscious diversity and rich soil and happy plants. So there's many worse things in life than that. And so that's been my own approach here.
Great. I'm actually really glad you mentioned that young couple that you're hoping to attract, because what we try to do at Peak Prosperity it is not depress people and freak them out with the bad data. We need to understand the math so we know what world we're living in, but we're really all about surfacing new models for doing things better, because that's really what we're going to need going forward. And we're certainly going to need a new economic and monetary model when this whole current deformed system collapses. But there's so many younger people right now who are feeling so depressed and disadvantaged as they look to their future, because it's so hard for them to raise capital now, right? And so new models that connect people with that energy and that enthusiasm, and who want to have a sense of positivity for their future, with people that actually have the capital, have the land, have the resources. It's great that you're out there pioneering that. I wanted to give you a chance to sort of soliloquize on what you were doing, because I wanted viewers to see here that each of these very august and very knowledgeable expert speakers that we have here are so concerned about the current situation that we're living in that they are taking this type of action in their personal lives, meaning, hey folks, it's serious. This is not something that you should just let go in ear and out the other. It's something you shouldn't ignore. It really is the time for action. That being said, I do want to say, Chris, too, that you had mentioned, you got a property that's almost 200 acres, you're putting solar photovoltaic on your home, et cetera. For those that do read the book Prosper, you don't have to buy a 200-acre estate to develop the type of resiliency that Chris is talking about, whether it's across your finances, whether it's with your health, whether it's in your community, whether it's with the physical space in which you live. So I just want to make sure that folks don't feel like you got to be making that type of investment to be able to have a shot here at becoming more resilient. Not the case at all. Anybody, anywhere can do this. And again, the book goes into more detail than I'll go into here. All right, folks, we're beginning to wrap things up here. As we begin to bring this to a close, I do want to try to end on a hopeful note, if at all possible. So my question for each of the four of you is going to be, what hope do you see in this story, despite all the concerns that we've been talking about for the past hour and 15 minutes or so? And if there's anything else that you would like to contribute to the conversation that I didn't think to ask you, now's your chance to do it. So Charles, why don't we start with you? Where do you see the hope in this story?
Well, that's a terrific topic, and I think
I wanted to start with you because the sunrise happening over you right now, I think, is really fitting this question.
yeah, and please excuse as I'm shifting my laptop around to avoid the Central Pacific sun, blasting through this my windows. Um, well, I think the source of hope for me is twofold. One is I think the awareness that we're living on a limited planet is rising, and it's rising across the spectrum in a variety of ways, and it's sort of halting. There's still a lot of delusion that there's an endless supply of cheap oil and cheap natural gas and cheap lithium, because we're going to use lithium to replace all the oil and natural gas. And there's a lot of delusions that are play upon human nature's desire for magical thinking as a solution. But so a little bit more realistic appraisal of the limits of our planet is a good thing, right? Because it means we're going to start moving to a model that recognizes that eternal growth is not an option, at least in terms of consuming resources, right? That's not going to work. Our financial model is set up on that model, right? That it's going to be more debt, more consumption, more use of resources. So if that whole model breaks down, then we're going to be in a better place for seeking an alternative financial system as well. And Mike and Grant have spoken to what that would look at. What would that look like? Well, obviously, it would be one where money was not created and distributed at the top of the pyramid, for the benefit of the few at the expense of the many, right? So it's not that complicated to foresee a financial system that was reset to something that was more likely to benefit the many rather than be focused on benefiting the few, right? And so, and we waste so much. We waste so many resources. We waste so much human potential. We waste so much time. We waste so much money. And it's really easy once you start digging into the kinds of things that we're talking about here in the real world, that you can realize, my gosh, I could live on 20% of the money that I thought I needed to live in a high cost urban environment. And so, you sort of generalize those lessons. And then you realize, wow, we as a planet could get by on a much smaller percentage of resources and debt, and make much better use of our human resources as well.
Very well put. Grant, how about you? Where do you see hope in the story?
Well, look, there's always hope, right? I mean, look, mankind has survived everything so far, and we will continue to survive this. I think, if you think about this, what a reset means, we always think about it as to what it means in the teeth of the actual event. But what it does is set people up for incredible opportunities. The trick is to have no debt and have the capital to pick things up after the bust. That's always the tricky thing. People get sucked in at the top, and that's exactly why when you do have a big reset, things are so cheap, because people are over levered and they have to get rid of them, and they look at anybody with cash to buy them. So, there will be fantastic real estate opportunities coming up. There will be fantastic businesses that are over levered and can be bought. I do think having gold and silver will help you with that. I think the rise of cryptocurrencies offers a fantastic potential lottery ticket. It's a tricky space to navigate, and I think you have to be honest with yourself if you're going to enter it as to how much time you're willing to commit to stay current with the developments, because you're either in or you're out. You can't be a casual tourist in the crypto space. Either put lottery money in it and hope that it all works out in the end, or if you're going to spend some time and serious money investing in it, you need to really commit the time to understanding the constant change and shift and developments. But I think crypto offers a fantastic opportunity. So it really, for me, the crisis is the opportunity, and people need to think of it that way, and try and position themselves so that individually to them, the crisis hurts them as least as least as it possibly can. You know, in bear markets, everybody loses money. It's the people who lose the least that win.
Right.
And that's an important thing to think about. You know, don't assume you can dodge a bear market. You can't. But if you're nimble, you're cautious, you understand where we are in the cycle, and you take chips off the table and keep them in reserve for when things go on sale, there will be some incredible opportunities in the next few years. And that's, you know, I'm excited for this crisis to happen finally, so we can actually get constructive and look for long-term purchases that you can make at fundamentally good valuations and not have to worry about.
Great argument for keeping some dry powder. Mike.
Sorry, I was muted.
No worries.
I do see that there is great opportunity and hope. One of the things that I do is, with the gold-silver ratio where it is, silver is so incredibly undervalued against gold, and gold is undervalued against the currency supply. When you're talking about supply-demand fundamentals with the precious metals, you're really needing to compare, these are money, and it's being measured with fiat currency that they keep on printing more of. And it will do that accounting. It has to balance against these fiat currency supplies around the world. By the way, if all of you, I'd like to ask all of you a favor. Stop calling fiat currency money. It does not qualify as money. It's portable, durable, divisible, fungible. It's a medium of exchange and a unit of account, but it is not a store of value. Only gold and silver have proven to be money throughout the centuries. And but right now, I'm collecting mostly silver. I intend on, when the gold-silver ratio drops closer to like 30, converting a lot of that silver to gold, and I'll be getting 3 times more gold than I paid for. And without the performance that I see with gold, I mean, I've never made as much. Grant was saying everybody loses money in a bear market or currency, purchasing power, but not everybody does. I mean, I made more than I have ever made in those months that the markets were crashing in the Lehman crisis and so on. And so if you're prepared the right way, I mean, my whole business and my whole life, I've sort of engineered for something that I saw coming back in the early 2000s. And it only got halfway through in 2008. So the crisis wasn't done, and they slammed some Band-Aids on it and pumped it bigger. But it offers tremendous opportunity to be able to come out of this with, like Grant says, cash flowing businesses, apartment buildings, high dividend yield stocks. There's a whole, but I don't call it the everything bubble. I call it the almost everything bubble. And that's what's going to be in my book, because it isn't everything. Gold and silver are not in bubbles. Mm-hmm. You have to measure those against the growth of the currency supply. And right now, they are incredibly undervalued. And so it's time to sell overvalued assets, buy undervalued assets. And even though this event is going to be bad, financially, it can be the very best thing that ever happened to you.
All right. So back to the old Chinese opportunity and crisis. This next crisis might bring tremendous opportunity for those that are well positioned. All right, Chris, let's have you bring it home, sir.
All right. Well, so I have a lot of hope, and it's sort of at the individual level. And I have a lot of hope around what's possible here. I completely agree with everything that's just been said economically, but I think what's possible here is the sense that we can do better. Right. So when you look at the macro statistics in terms of obesity or suicide rates or depression, demoralization, I think we could look at those objectively and say, wow, we can do better. There's something about our culture and the way it's configured that is isolating, leads to a sense of loneliness, separation. There's a lot of really stressed people out there. And this is at a time of really massive abundance, actually, by any historical standard. So I'm measuring my hope in terms of what's possible. I love what's coming down the pike with the regenerative farming practices, but also with people starting to, younger people in particular, looking beyond the simple trappings of consumerism and starting to ask the bigger questions and starting to think long term again. That's the thing I'm most excited about, is for people to get curious, realize they have a stake in the game, and start asking the question about things like economics, like, hey, maybe we should have a say in that. Maybe it's not okay that the Federal Reserve just decides to throw 400 billion in to the markets in a couple of, relatively couple of months. That's it. So I'm really hopeful about what's possible. I love the fact that people are starting to get engaged again. I like the fact that people are disengaging from the raw consumer culture and what little it has to offer, and starting to get back involved in things that I think provide a better chance of meaning, purpose, and authentic expression. I really do think that that's the wave of the future. I can really feel like that's what's pulling. That's where a lot of energy in the story is for people saying, did the old story, see it, and not that interested in perpetuating it much longer. That's one of the tensions in the system, is that the powers that be that's all they're perpetuating, is that same system as they run rackets on us. My healthcare premiums went up 22% again this year, right? It's just awful. It's just rapacious. It's immoral as well as amoral, right? People are getting tired of that. And so that's where I think, things have to get dark before they get bright again. And I actually think that we're going to start seeing, people just letting go of the old and putting their energy towards the new. And that's always hopeful. I love seeing what's coming and what's arising in this space right now. So that's what I got.
Great. Well, as we're at the cusp of a new decade, hopefully we certainly as individuals, the folks watching this, can work on adopting new, better models of the type that you're talking about. And who knows, once this correction happens, maybe society will get its wake-up call and start being willing to consider some better models for doing things differently and more sustainably going forward. So with that, I really want to thank everybody who participated in this webinar. Gentlemen, thank you from piping in from all over the globe. For folks watching, if you want to learn more about Charles Hugh Smith, go to of2minds.com. For Grant Williams, go to Things That Make You Go It's TT. Oh gosh, Grant, you say it.
Go to ttmygh.com.
ttmygh.com. For Mike, go to goldsilver.com. And for Chris and myself, go to peakprosperity.com. We'll also put a URL up here, greylockpeak.com. That's the URL to go to fill out a short form if you would like to have a free consultation with that financial advisor, New Harbor Financial, that Chris was talking about earlier. And gentlemen, Charles, Mike, Chris, I know I'm going to see you guys at the Peak Prosperity Annual Seminar coming up first weekend in May of 2020. Grant, I don't think we have you on the roster for this year. Of course, if you're in California that time of year, we'd love to have you. But if not, hopefully we can get you in a future year.
I'm sure our paths will cross at some point.
Yeah, they will. But gentlemen, again, I want to thank you so much. And for everybody watching, we'll be sending you a series of emails for anyone who's registered with this. You'll get the replay video sent to you. You'll get a little postmortem from the guys at New Harbor Financial with their top level thoughts on how investors might be able to position themselves given the types of strategies that the speakers mentioned here. We've got a couple other resources. I've been making notes here based upon the speakers' comments of resources that might be helpful to you, like how to invest for income and whatnot. But with that being said, thank you all for watching, and we look forward to seeing you on the next webinar that we produced. Thanks again, everybody, for piping in.